Finance Minister's announcement on the sharp reduction in corporate taxes last week was cheered by both the leaders of India Inc. as well as equity markets. Let's do a three-point analysis to understand how the auto and FMCG sectors will benefit from these tax cuts. 1. Refueling growth in the auto sector. Well, the Indian auto sector, which contributes 7.5% to India's GDP, has been reeling under multiple blows on the back of myriad macroeconomic challenges. Factors such as non-availability of retail finance, liquidity crunch and slowdown in the economic activities have impacted the demand. But the biggest reason for buyer has been the increase in total cost of ownership led by mandatory long-term insurance and implementation of safety regulations. Reduction in tax rate would improve the profitability of companies in this space, but more than that, it may help companies to pass on the benefits to the consumers as well in terms of discounts and freebies right ahead of the festival season, which may actually prop up the demand as well. Moreover, the move would also give more liquidity to the companies for further investments who had shelved the plans for investment due to the slowdown. In terms of individual company in this space, companies which are paying higher tax stand to benefit more. For some automakers like Eicher Motors, the tax has been reduced by over 900 basis points. Within the auto ancillary space as well, in the list, barring Apollo Tyres and Varroc Engineering, other companies seem to gain quite a lot. 2. FMCG companies to get more cash in hand. Well, corporate tax reduction would significantly help FMCG companies in retaining higher cash in hand, which could be broadly utilized for spurring demand through trade discounts in the upcoming festival season as well. To give an estimate, FMCG companies in Nifty such as ITC, Nestle, Britannia and HUL would see their effective taxation reduced from 29 to 35% to right away 25%, leading to roughly retention of cumulative 2,000 crore rupees earnings on the basis of the FY19 numbers. Now, this corresponds to 9% of net earnings for FY19 too. FMCG leaders like HUL, Britannia and Colgate will continue to invest behind distribution reach, cultivate newer channels such as e-commerce and also announce offers in the upcoming festive season to stimulate demand. They are also expected to gain market share from here on. However, some of the companies where effective tax is already at or below 25%, such as Dabur, Marico, or Bajaj Consumer and even Imami, they would not stand to gain much. 3. Which stocks should investors really buy right now? Well, Moneycontrol research bets on Colgate and ITC from the FMCG space. We expect Colgate to increase the market share gains from here. And ITC will not only get the earnings boost from tax cuts, but also the status quo on GST taxation for cigarettes business is also quite a big relief. Further, ITC also gains from GST rate tax cuts in the hotel segment. From the auto space, investors could look at Eicher Motors, Escorts, Hero MotoCorp and TVS for long term.